ticker symbol TGIF. TGIF is an actively managed ETF that holds bonds and other fixed income securities. They're the first ETF to distribute income on a weekly basis. They're exposed to over 100 different bonds across multiple different industries and capital structures that help them maintain risk and put it at the lowest amount possible. They have over 30 years of experience with value-oriented managers. Their goal is to provide current income. There's no minimum investment for this ETF, and the expense ratio is 0.59%, meaning every $10,000 you put in, you'll be paying a $60 fee in return. The top 10 holdings for this ETF are cash, along with multiple other bonds and credits from credit issuing securities from other companies and financial institutions. As you can see, since TGIF has been incepted, they're down 5.25%. They opened at $100.28 and reached a peak of $107. They're now at $95.01. The dividend rate on this ETF is $4.91 per year with a yield of 5.2%. But sadly, due to it being a newer ETF and not much news being out about it, the assets under management are under 17 million for this ETF, and their volume is very low at only 1,700 shares being traded every single day. The holdings break down as mostly corporate bonds, then securitized bonds, and then cash, and then government treasury bills. The largest is the Ford Motor Company, and then Credit Suisse, First American Government, and then a number of other financial institution bonds. Expense ratio on this ETF is 0.59%, which is a little bit higher than all other ETFs. Most are about 0.48%. So this will be on the more expensive side. But unlike most ETFs, TGIF pays a dividend that is over double the median average, and their growth is almost double what the average ETF growth is. I really like this, along with their dividend growth CAGR at 266%, while most ETFs is only 8%. They rose their dividend from 5 cents a week all the way up to 9 cents now. Over time, as you can see, it started out low, their yield, but then throughout the time of paying more in dividends and then special dividends being introduced, the yield has only consistently gone up. The yield on cost has stayed above 4% of this ETF, with, in some cases, the yield reaching over 5%, like it has right now. The growth in this ETF started out in 65 cents in 2019. In 2020, it jumped up to $4.04, and then in 2021, it was at $4. What makes this ETF a little bit different than a lot of other ones is they do pay special dividends, so that's where this fluctuation does come from. We go over here to the dividend history. We can see that they've consistently been paying out 5 cents every single week, and then it was jumped up in 2022 to 7 cents, and then most recently in July it was bumped up to 9 cents. If you look right after Christmas, to reward shareholders, they do an extra special dividend of $1 and above. It was first started out at $1.49, and it was $1.27 this most recent Christmas. I'd be expecting a dividend around $1 to $1.20 this year around, and equated with the 9 cents a year, you'll be looking at around a 6.5% dividend yield at this current spot price. 9 cents per week being factored in with this ETF is very minimal compared to a lot of other ETFs because they only hold bonds and other credit issued securities, but they do not have many shares outstanding compared to most other ETFs such as SPY or QQQ. So the volatility on this ETF is going to be not as much, but the risk of liquidity being there is horrible. So if you ever need to get your money out very quickly, you will not be able to because there is not enough buyers than there is sellers. That's why the rating is an F. If you look at TGIF's assets under management, it's 93% less than the median for all other ETFs, and their average daily share volume is only 1,400, while the median for all other ETFs is 38,000. All these metrics show that TGIF, although being a nice dividend ETF, poses significant risks when it comes to volatility and need of pulling assets out because the lack of buyers and the lack of assets under management, creating for a non-existent liquidity and a spot price that is poor sometimes and can be dollars off of what the spot price is due to high spreads affecting price variations.